Good morning. Welcome to Market Monday for January 8th, 2024. Well, it looks like Santa had too much eggnog this year, as last week we experienced a failed Santa Claus rally. As Chad mentioned a few weeks ago, the adage goes, should Santa fail to call, bears may come to Broad and Wall. What does that actually mean? And what did he say about the Santa Claus rally? Did Chad say anything about the predictive power of the Santa Claus rally? Let's see.
The Santa Claus rally gets a lot of attention, obviously because it's a good name. But is there something more to it? Turns out, yes. In fact, these 7 days are more likely to be higher than any other 7 days of the year.
So the Santa Claus rally really means the market has a higher likelihood of being higher. So what's happened in the past when Santa Claus failed to call? We see it's happened 16 times since 1950, and we see that the month of January, the first quarter, and the full year were all sort of a mixed bag. Of course, we did have the dot-com bubble busting and global financial crisis in here. And we did just have 9 straight weeks of stock market gains. So perhaps a bit of a breather was in order. And so as we kick off the new year, we find it's always helpful to remind ourselves, why are we investing in the first place? Why do we participate in the tantrums and drama of the stock market? Gains, of course, growth, perhaps. Those are certainly nice, and we want those, but let's take a step back. Here in red, we're looking at the purchasing power of the US dollar since 1993, about 30 years, down over half. If you were hiding out in safe, let's add some quotations around safe. If you were hiding out in quote unquote safe assets since 1995, congratulations, you very safely lost half your purchasing power. Now what? For most of us, most of our clients, that is an unacceptable scenario. Now here in blue, we have the S&P 500 stock market. Adjusted for inflation, you're up 793% after inflation. And you didn't have to lift a finger, but you did have to do something. You had to tolerate just brutal volatility, existential drawdowns, nerve-fraying uncertainty, noise and news so loud it could drive you mad. You had to do that. You had to do that. But guess what? That's all you had to do. So the reason we add other assets, other styles to your mix is to try to make all that stuff that's utterly intolerable tolerable, so that number one, you can maintain your purchasing power over time throughout your lifetime, and maybe even for the next generation to come. So reason number one for investing is not for gains or growth, but to protect purchasing power over long periods of time. Reason two, growth. In the same spirit of starting the new year going back to the basics, let's revisit. Where do stock market gains come from? There are 3 sources of returns from stocks, and it may surprise you which one gets the most attention versus what has the greatest impact on prices from year to year. Here we're looking at the 3 sources of returns, along with the total return since 2019. What color do you see most? You're probably saying either orange or blue, and you'd be right. Orange is labeled here as PE multiple, but what that really means is the valuation of the stock market. Is it cheap or expensive? When the PE multiple is high, stocks are said to be expensive, and when it's low, stocks are said to be cheap. Just for reference, here's the PE multiple going back 40 years. In the dot-com bubble and subsequent crash, you see the PE get up into the nosebleeds, then gravity brings it back down. pretty low throughout the real estate bubble leading to the global financial crisis, which brought the PE down to an all-time low, generational buying opportunity. But who would have had the fortitude to buy when the financial system as we know it was hanging on by a thread? Then you see COVID, post-COVID boom/bubble, then coming back down. There are a ton of nuances to this, and you can see it's not a magic timing tool, but for our purposes here, we should view it as a measure of risk appetite. If PE is high, folks are willing to pay more for stocks. 2019 market up almost 30%, risk on. 2020, after the government came in with massive support, even though actual earnings were down, spoiler alert, earnings are the blue bars. So even though earnings were down, risk appetite pushed market prices up over 20% for 2020. Then in 2021, there was an actual earnings recovery, the solid blue bar here. Earnings do matter over time. The market cannot go up year after year on PE multiple alone. It often happens that the orange PE multiple moves first, and then the earnings sort of backfill to support prices. Then guess what? In 2022, inflation skyrockets to the highest rate in 40 years. The Fed hikes rates at the fastest pace in the last 30 or 40 years, which crushes risk appetite. Look, earnings were up for 2022, but risk appetite was enough to drag markets down right around 20% for the S&P 500. Last year was a nice recovery of both. Inflation coming down dramatically, no recession, full employment, solid earnings, solid economic growth, folks still licking some wounds from 2022 and not ready to get back in the market yet. And yeah, that's about what that kind of year looks like. But what gets the most attention? Earnings, right? What else gets attention? Dividends. As we've talked about before, dividends are not free magic money. You can see them here in gray, a small but consistent source of total return for the S&P 500, around 1.5 to 1.75%, give or take. If you had a business and that business distributed $1 million to shareholders, would your business still be worth the same as before the $1 million distribution? Of course not. That's exactly how dividends work, folks. Or better yet, when you make a payment, a distribution to the IRS, is your net worth the same? Of course not. Same math for corporate dividends. Bottom line is, what drives stock prices most in any given year is the PE multiple or risk appetite of investors. It's great to be back with you in 2024. There's so much we're going to cover in the coming weeks, including the presidential cycle, seasonality, and of course, our favorite topic of all, the media. Today, we'll leave you with what all the analysts predicted the stock market to do in 2023. Folks, friends don't let friends pay attention to analyst predictions. Have a great week.